Hey, did you know that some tax-exempt organizations can actually be taxed on their income? I'm going to share some information with you. Let's get into it. Hey y'all, this is Tiffany with Boss in the Budget. I help new and small nonprofits get up and running. If you need help with your nonprofit, be sure to subscribe because I drop videos every week. Today I'm going to discuss a topic that you may have never heard of, but you should be aware of, especially when it comes to raising money for your nonprofit. That topic is unrelated business income tax, and sometimes it's referred to as UBIT. That's the abbreviation, and that is when nonprofits, even though they're tax exempt and they have their 501c3 status, still taxed on some of their income. So in this video, I'm going to talk about in what circumstances is that the case, why is that the case, and what you need to be mindful of so you don't run into any issues with that. Also, make sure you watch to the very end of this video because there are some exceptions. So in some circumstances, you have to be taxed on your income as a nonprofit, but there are some exceptions where you can get away with doing some business related activities and the IRS won't tax you. So I want you to stay to the end of the video so you can hear some of those exceptions so you can be aware of what you can and cannot do or what's advisable to do as a nonprofit. Okay, so it's a very, very simple concept. I'm not going to spend a lot of time on it. First of all, because I'm not an accountant and I'm not your accountant, so you need to make sure you have a good accountant as a partner with your nonprofit. But unrelated business income tax is when you are conducting a business activity, a trade related activity where you're selling a product or you're selling a service that's not really focused or related to your charitable purpose. So an example would be you have a building as your nonprofit and you rent out certain spaces in your building, let's say to a local tax preparer that has nothing to do with your charitable purpose, but because you have space and it's an opportunity to make money, you rent that out on a monthly basis so you can have extra income. Well, if that's not directly related to your charitable purpose, then the IRS sees that as unrelated business income and it's subject to be taxed. So if you make more than $1,000 gross income a year from unrelated business income activities, then the IRS will tax you on those activities. So at the end of the year, when you file your annual tax form, your 990 forms, you have to also submit an additional form called the 990T, for T as in Tiffany, to report that extra income so they can assign tax to it and you can pay that tax. If you know that the tax for the year that you have to pay to the IRS based on those activities is more than $500, then you're supposed to be estimating your tax every quarter and prepaying the IRS before the end of the tax year. So you're supposed to be filing your quarterly returns on that income so that the IRS doesn't have to wait to the end of the year to collect tax on the money that you made. So how do you even know if the work that you're doing is unrelated business income? What is the best way to tell? Because I know for some of you, you're like, well, we need to make money. We don't want to only rely on donations. We don't want to only rely on grants. And I completely agree. You should be using some kind of revenue generating activity where you are selling a product or you have a service. I always recommend, though, that it's substantially related to your charitable purpose. Well, here are 3 ways that the IRS gives to tell if it's unrelated business income or not. The first test is whether or not it's a trade-related activity. So what they mean by that is, are you selling something as a business, right? So are you selling a product? Are you performing a service that you're getting paid for? That's one signal that it may be unrelated business, but it also has to meet the other requirements. So don't get too scared right now. It has to meet the other 2 requirements that I'm going to talk about as well. Second, you have to ask yourself, is it regularly carried out? So are you doing this on a regular basis? So you're doing this probably on a regular frequency. It's something that is expected part of your business is similar to other businesses that provide other services, is your frequency similar to them, is your pattern similar to them, then that may be a signal that's unrelated business income. But on the other hand, if you're doing like a fundraiser where you're selling t-shirts, or you're doing a bake sale and you're only doing it once in a blue moon, or it's not like regularly scheduled, then that would not count as unrelated business income. The third test is to ask yourself, is it substantially related to the charitable purpose of the organization? So that's the test right there. You can meet the other two, but as long as it's meeting the charitable purpose, you're good. But if the work that you're doing does not meet the charitable purpose of your organization, then the IRS more than likely will see that as unrelated business income and will require that you be taxed on that income. So one example might be you have an animal shelter where you house animals and you foster animals, right? But you have a pet store online where you sell pet items, where you sell pet food or pet supplies. That's not a charitable purpose. That's a trade activity. That's something that you're regularly doing because it's always up online, and it really does not relate to your charitable purpose. Selling pet supplies does not really relate to your mission around, saving and housing animals. So that's one example where you would have to pay tax on the income that's generated by your online store. One thing to keep in mind is that if most of your activity is related to that business income and it overshadows your mission work, then the IRS will flag that and you can potentially lose your tax-exempt status, because then it all becomes about making money for the business, not the purpose of the mission. And the whole reason why you were granted tax-exempt status is because you're doing charitable work. And if your charitable work is overshadowed by your business income related to a trade that has nothing to do with your charitable purpose, then the IRS will see issue with that and may take away your tax-exempt status. If you need suggestions for other ways to make money beyond donations and grants, you want revenue generating activities, I do have another video where I talk about some examples, and also have a freebie, which I'm going to link below, which gives you 50 ideas for making money using earned income strategies or fee-for-service strategies. And again, the whole point of that is make sure whatever activity that you select is related to your charitable purpose. So I promised at the end of the video to share some exceptions, because leave it to the IRS to have all kinds of exceptions and complications on rules that they put out. So I really recommend that you check out the publication that I listed below that talks about unrelated business income tax, so you can be well versed in this, and also so that you can be prepared to speak with an accountant so you know the landscape and you know what you're getting yourself into. So the IRS does say there are some exceptions where you don't have to be taxed if you're doing trade activities, if it's not necessarily related to your mission, and if it's regularly carried on. So some exceptions would be if it's an all volunteer run nonprofit, if no one's getting paid to help with those activities, you may not have to be taxed on the income that's made from that income generating activity. If you're selling donated merchandise, so, the first thing I think about is goodwill. If you're selling merchandise that you're not paying for and it's all donated, then you may not have to pay tax on all the income that you make from selling that merchandise. Another example would be if you're conducting a business only at the pleasure or the convenience of your participants or your members. If you're like a membership organization, one of the examples that the IRS gives is like a school cafeteria. If you're a college and you're putting this business in place to serve the kids who go to the college or the students who go to the college, then that's just at the convenience. That's the reason why you created it. Another exception is bingo, which is so random to me, but another exception that they call out is bingo activities or bingo games. So you may not have to pay tax on the income that you generate from bingo activities. But the key to all of this is know the rules and talk to an accountant. So I'm giving you general advice, but I cannot speak to the specific situations that you're in. That's why I'm saying may not be taxed. You may be taxed because you really need to do your own research for your specific situation to make sure you don't get into any issues with the IRS. So if you all need help or if you need more advice for starting a nonprofit, Make sure you visit me at www.bossonthebudget.com, and I'll see you in the next video.